Oh, John, we're gonna talk about bats.
Yeah, we're going to be talking about XABCD patterns and the Gartley in particular, because that is where it all began in relation to XABCD patterns. It's a good segue from the ABCD patterns that we went over last week, which, if any of you haven't seen, the recording is in the chat as well.
Yeah, I got that book. I think I downloaded somewhere you recommended the Gartley book.
Hmm,
Oh, cool, my favorite, John. All right.
right on. Well, yeah, we'll go ahead and get started here. So yeah, today we're going to be going over the Gartley, and that is the first XABCD pattern that I think is the most relevant to go over, and it is for beginners, so it does help having one over the last class, but it's not completely necessary. Uh, and here's the disclaimer briefly. So today we're going to go over what is an XABCD pattern, the four price moves that form a harmonic pattern, and how to apply and trade using harmonic patterns, and the Gartley 222, what it is, how to apply it, how to use it, and understand it. And what is a harmonic pattern or XABCD pattern? So an XABCD pattern, there are 5 points to each trading pattern that is an XABCD pattern. Now there's different variants as well, but they're often called XABCD patterns as each letter refers to one of the 5 points in the pattern. They're called harmonic patterns because of their integral relationship with Fibonacci numbers. Fibonacci numbers can be seen all around us in the natural world, and these harmonic ratios are also present within the financial markets. And as we can see, we often say that it is a nature over nurture matter. Not a lot of people are aware of the fact that they've been in use since before the traders were even using charts. So quite interesting. The roots of all harmonic trading can be tracked down to the Gartley pattern, the one that we're going to go over today. The Gartley 222 pattern is named from the page number, which can actually be found in H.M. Gartley's book on page 222 in Profits in the Stock Market, and that's it on the bottom right there. So Fibonacci numbers, and many of you will have noticed this one from the last slide. I just briefly wanted to go over it so we're aware why they're called harmonic patterns, because they work in harmony with Fibonacci numbers. And Fibonacci numbers, I just basically wanted to go over quickly here for you guys. So the numbers used in harmonic patterns are either directly or indirectly derived from the 0.618 and 1.618 ratios of the Fibonacci sequence. And these derived numbers include 0.76, 886, and so on. But these are also uh, other numbers that you can use as well. Like you'll notice that there's on each Fibonacci scale that we use, there's a 38, a 50, a 78, and an 88.6, and 141 and 188, and so on. So these numbers they're used to validate harmonic patterns and determine areas of potential changes in price. So as we know, the golden Fibonacci ratio is 61.8, and it's a very important level when analyzing with Fibonacci tools. I make that yellow on my scale to correlate with the golden ratio, and it also stands out tremendously. So yeah, and there's a little explanation at the bottom of the golden mean. um, so sorry if you can hear me. The four price moves that form a harmonic. So in most cases, these patterns consist of four price moves, all of them conforming to specific Fibonacci levels. Therefore, a harmonic chart pattern should always be analyzed using Fibonacci retracement and extension tools. And a lot of you guys will be familiar with them from the past two classes that we went over, because they're one of the most common tools that we will use, and we'll get into how and why they're used with harmonic patterns in a moment here. But these four moves are typically shaped like an M or a W, as you can see on the bottom right here. I've basically just drawn in, basically an M and a W, and you can see how there's four different price changes within each pattern. So basically the M and the W are inversely correlated. Now they do mean different different results. So one of them that shaped as an M generally would be bullish, and the one shaped as a W would generally be bearish. So yeah, and there are different variations to these patterns, and they're all calculated using Fibonacci tools. Hence, harmonic. That's why they're called harmonic tools, because they work in harmony with Fibonacci's, as I said. So the rules for trading bullish and bearish patterns are the same. We just need to take into account the direction of the pattern that you're trading. So like whether it looks like an M or a W. So just as a quick brush up from last week, this is last week's ABCD pattern that we went over, and I just wanted to quickly show you guys how they're 3-point patterns, and or 3-wave patterns. So essentially, they move up with one move, and then down with another, and then up again with another move to complete the entire pattern. Whereas the uh, XABCD pattern has one more move, and that simply makes it more advanced. So here's a rough example of an XABCD pattern. Now, many of you guys have seen this rough drawing, and we're going to go into exactly what it means. So basically, you can see that there is a shape of a rough W there. So it starts with an X, A, B, C, D, and that essentially gives us the pattern, which gives us the exact precision result in which we're looking for. Now you can see here that we've plotted Fibonacci retracements on top of the pattern in order to get our exact entry and exit points. With in this case being the 188 fib, it was the turnaround point. So I just wanted to quickly go over, exactly how, in this case, this harmonic pattern was analyzed. So what we're going to do is we're going to look first off at how the X to A to B to C was formed. So first off, we can see that from the A to the B, if we apply fibs, it's merely a 61% retracement to get to that C point. So to calculate that was the C point off of the 61.8, all we would have to do is apply fibs from the A to the B. And essentially, that 61 being the C point gave us an idea that this pattern may form a W if it was to hold that level. Now, there's different variations of these patterns, and we're going to go into one that's very specific in a moment. But essentially, I wanted to emphasize on how important understanding XABCD patterns actually is, because they actually happen so frequently. And we're going to go over that right now, because this pattern that we're looking at right now is the middle version of this. So we can see now that, it came from one pattern that was essentially a W, and then it formed the pattern we were just looking at, and then it also formed another W right after it. And I just wanted to show you as well that this is the exact same chart. There, instead of applying it to the W there, I've applied it as an M, and then we can see there's a smaller M in there. And just for some quick perspective, you can see that M identified right here in the middle of this W. And yes, and so you can also see it happens in this smaller one here too. I'm not sure if I identified that one on the next page or not, but in time they will go. They will become a little easier to identify. And you can see that from one essential W, it formed an M and has never stopped on this chart being part of an M or a W. Now there is a theory that many traders that specialize in harmonic trading would say that the market is always in a harmonic pattern, and if it's not visible, then we're just not seeing it. So it might be happening on the um, shorter term time frames, or very long term time frames, and all the moves within the short term can be forming a larger harmonic pattern, and therefore keeping it in play at all times. But we can even see that throughout this price action that we had here on the right can form larger M's as well. So we can see that constantly these two patterns that we see on the chart right here are in play very frequently. Now we know, and in our last class we went over the ABCD pattern. That ABCD pattern was was quite frequent in the week that we just had as well, and it will continue to be. Now another one that we're going to go over today is this XABCD pattern. Now we're going to go over one particular kind of pattern here, and this is the bullish Gartley and the bearish Gartley. So it's the exact same pattern, just reversed. The same Fibonacci retracements apply on each one. Now we're going to quickly go over, exactly what this means, because we know the rough idea this pattern is supposed to, it's supposed to have like that M type movement to it. So if we look at these numbers, it may seem confusing to begin with, but we're going to actually go over what makes them so important. So for instance, we can see that there's a 61.8 here. Now similar to the one that we were just looking at, we could see that its point that it first retraced down to was a 61.8. So in order to get that, here I'll show you. Um, this slide just basically shows how there's many different variations of harmonics, but sorry, this is exactly what I wanted to show you. So from the X to the A, we can see that we made our first move. Now our second move is from A to B. Now that A to B is a 61% retracement, and that's what this line is basically telling us. Now if we look at the A to B lines, the next move off of that A to B would be the C leg, and that would be giving us these levels here. So essentially, the level that's connecting is telling us exactly how much of a retracement that it is from that original point. So if we look at X to A, um, the retracement all the way down to the D leg would be a 78% retracement. So if we take a look at the line that's connecting the X to the A with the number, that's the number that's essentially telling us that that's how far it retraced into the X point, which is really not too relevant due to the fact that we use Fibonacci retracements on every single relative move anyways. So we really just for some perspective, it's good to know exactly what those numbers mean. So if you were wondering, that's exactly what they are. They're just retracement levels. If we're looking X to A, what was the retracement that the B was from X to A, and that would be the 61%. But yeah, so the Gartley harmonic pattern is the one that we're going to go over, and many technical analysts use the Gartley pattern in conjunction with other chart patterns or technical indicators. For example, the pattern may provide a big picture overview of where the price is likely to go over the long term, but traders will focus on executing short-term trades in the direction of that predicted trend. So if like we've got a daily Gartley pattern where we can see that there's like 500 points to the profit target, and that might take the course of a few days, but we know that over the course of those few days it's going to have plenty of bull runs that might get us towards that price target or beyond. So we might be more favorable of trading in that direction due to the fact that there's a larger pattern in play. Um, it says here as well that the stop loss point is often positioned at the X point or slightly under your entry, and the take profit is often at the very least the C point or the 161 from the A to D. Now we're going to go into that a little bit more. I just want to essentially show you a little bit more about the parameters for this pattern before we go into that. So the move from X to A, as we can see on the right here, it can be any type of move. It can be any size. It can be on any time frame. So you'll notice that this pattern will happen on from all the way from the monthly chart down to the 30-second and 15-second chart, depending on if that is the way that you trade. And the uh, that is the only move that isn't analyzed using any Fibonacci ramifications. It can be of any size. So this X to A move can be, if you're trading stocks, it can be hundreds of dollars, or it could be a few cents, depending on what it is you're trading, or a few points if you're trading futures. So yeah, basically the next move into the X to A is the first move that we would consider using Fibonacci's retracements on. So from the A to the B, it should be a 61% retracement of this original move. So basically, if we do take a look at a chart here real quick, and we have a rough move down, this move up here that it's having from A to B has to be a 61% retracement, okay, of we use all the fibs there. It has to be a 61% retracement to get up to the B point in order to satisfy the perfect ramifications for the original Gartley pattern. So we have our X, whoops, all the way at the top there. We know that that next move in, which is creating our B point, is going to be at that 61% level. And essentially the move from B to C should be a 38.2 or an 88.6. Now you can see here on the chart on the right, it tells us the 38.2 or an 88.6. So there's a couple different potentials that it could get to on this next retracement. So basically, what we're expecting on this next retracement is for it to be a 38.2. So we would remove these first initial fibs, and we'd be looking at this next move down here, and we'd be looking at that to get to the 38.2 off of that move essentially. And I just wanted to ensure everyone understands this, so I'm going to go over it like that. So in order to get our C point, oops, which would be here, that would be at our 38.2. You know, and it could have been at the 88.6, but we're going to use that one for now. And essentially, if the, you know, this is another thing that's really important. If we can take a look at the, you know how it has 38.2 or 88.6, we'll notice that the next move has a 1.27 or a 1.618 to get to the D leg. So if it is a 38.2, then you want the D leg to be a 1.272, you know, and the 88.6 should correspond with the 1.618. So if the retracement of move to B to C is a 38.2 of moved A to B, which we just went over, then C to D should be a 1.727. So, you know, this 38.2 correlates with the 1.27, and the 88.6 correlates with the 1.618. So it's actually really interesting how precise these patterns actually are, and they actually tend to reverse with absolute precision on each one of the harmonic Fibonacci levels. So as we went over, consequently, if the B to C move is the 88.6 of A to B, you know, if we get the C point as an 88.6, then the C to D leg should be a 1.618. Now there's another thing that we can do to to add some confirmation to this move, and it would be to measure the what we would do is we would measure the X to the A move to get our 78.6, which we'll go into in a second. But essentially what we want to go over is the fact that we would be looking for a 1.727 move for this D leg right here to complete everything. So like, because it was a 38% retracement at the C leg here, we're looking for a 1.27 to finish our D leg, and then a complete trend reversal. So essentially, our pattern would be left looking like this. And that is the rough idea of this pattern and how it would form. But essentially, we can see that on this next page here, we can see that move C to D should either be it should be a 78.6. Now you can see that the X to the D move is highlighted with a 78.6. That basically is just saying from the X to A move, it should be a 78.6 to get to the D. So basically, if you're just doing an X to the A, it should get to that 78.6 level just for some added confirmation. But usually, you might see a little bit of change on that, and it might not be exactly precise with the 78.6, but it's more important that you're getting the D point at the 161 or the 120. 127 in this case. So basically how the pattern is essentially formed can basically tell you how important the 127 or 161 can be. So if we can see that, that C point's retraced at a 38.2, there's a better chance it's actually going to reverse at that 127. And when we see the many trades reverse at the 127 and so many different patterns reverse at the 127, the question would be is, hey, was the last bull flag a retracement to a 38? What did we get this A, B, and C to a 38? Because that would explain why it went to the 127. Now, another really interesting thing about this pattern is the playout isn't merely just to the B point. It's actually to the 161 of the A to D. So the entire pattern gets fibs put on it, and we get to take it all the way to the 161.8. So this is the bullish Gartley. The green arrow on the image represents the expected price move of the bullish Gartley pattern. The full target of the pattern is the 161.8 Fibonacci extension of the A to D move. So basically all you would do is apply fibs from the A to the D and get your Fibonacci extension. So if we take a look at a brand new chart here, we'll put on uh, a rough pattern here. All we would do is get our Fibonacci tool, apply it from the A to the D point, and we would be going for that 161 all the way up there. Now there is something to be said for the 188 as well. The 188 can always be a price target and a reversal point for any harmonic pattern. So this is one of the most important levels in any single harmonic pattern, whether it be a ABCD pattern or a XABCD pattern. So another really interesting thing about Gartley's is the A to D move here from A, B, C, and D is actually an AB equals CD pattern. So many times you'll notice that the exact same distance from the A to the B is the exact same distance from the C to the D. And another thing that we're going to go over, which is quite interesting, is the time. But we're going to go over that on the next slide, I think. However, there are intermediary targets before getting to your E point up here. So one thing that's important is, yes, you can ride it all the way up to the 161.8 or the 188, but each point is also a potential reversal area. So the B point of any harmonic pattern we know is a very, very important level. And in this case, a badly positioned Gartley may only go to the B point. Now, many different patterns can have trouble playing out due to the fact that there might be momentum divergence that's not supporting their playout, or it could be positioned really badly, or there might not be a lot of volatility. Like for instance, the pattern might form at a really awkward time before a meeting or event where the market phases out into a sideways trend. That's always possible. So we always have to make sure that we run the system on those things. Um, so yeah, it's exactly. So it's imperative that you run the system that's taught in the first class. It's always recommended that you use the stop loss order. Always have a stop loss order on every single trade, in my opinion. But this is the way that you'll protect yourself from any rapid or unexpected price moves. If you open a bullish Gartley trade, your stop loss order should be located right below the D point of the pattern. If you open a bearish Gartley trade, your stop loss is located right above the D point of the pattern. It's just exactly inverse. The parameters are exactly the same, just flipped around when you're doing it in reverse. Now, below you'll find an image showing an ideal risk-reward positioning of a bullish Gartley stop loss order. The preferred method for trading Gartley is to enter a full position at the D point and scale out at different levels. The targets look like the other points in the pattern. So the A, the B, the C, and of course the E point being the 161 of the A to D. So if you have any questions about any of that, let me know as well, because I want to make sure that they're all answered. And of course you'll be able to go over this again in the recording, but here's an example. So basically, we can see I've basically found this example of a Gartley, and it's quite good actually. The the A to D extension is the 161.8. We can see that it did go higher in this case, but each and every pattern point on the pattern is a target, and you can see each particular level you can trim some off with a final target of it being at the 161 or 188. Now, as we can see, there are 4 reversal points to this pattern. The pattern can definitely exceed the 161.8 and create a more extended E point. The 188 is a common reversal point for every single harmonic pattern and must be considered when a price point nears a 188 fib drawn from any previous harmonic pattern or consolidation prior to the creation of the current point. So like if we have a fib coming from a previous pattern and its 188 lines up somewhere along the trajectory of our current pattern, we have to take into consideration that 188, even if it is an old 188, because it is that important, especially bigger patterns. Now, this is the interesting part of a Gartley as well. So we can see that there's 2 different time factors in this. So the x to the a point being equal to the a to the d move. So the time that it's spent going down should be equal to the time that it's spent going up. So yeah, as we can see from point x to a, the time down is equal to the time spent going up. The pattern ideally spends the same amount of time in a downtrend that it does in an uptrend through the a to d points. That's quite interesting. And you'll notice that that can be different. They might not line up precisely in time as they intend to. The levels, I would say, are way more important than how much time is required on the Gartley. But you know, with that being said, there is a perfect Gartley pattern formation with the exact levels and time taken into consideration. So a Gartley forms when the price action is has been going on a recent uptrend or downtrend, but has started to show signs of a potential reversal. So Gartley's will happen in exhaustion areas naturally to reverse the trend. Gartley is one of the most commonly known harmonic patterns. It forms its reversal points off of Fibonacci retracement and Fibonacci extension levels, and these levels can give a stronger indication of reversal when combined in harmony with these price movements. And the pattern contains a bullish or bearish ABCD pattern, but it is preceded by a point X and beyond that is beyond point D. So essentially, as we can see on the bottom here, um, it essentially is just one move up before an ABCD pattern that can give us uh, expectations on how that ABCD pattern should play out and increase the effectiveness of it that much so. So, in the at the beginning, this pattern can be hard to spot, and once you do, it can get confusing when you apply all the different fib tools to it. The key to avoiding all of that confusion is to take things one step at a time, and to separate harmonic fib templates to avoid clutter. Now, I'm sure I went over this in one of the other classes, but these are the 2 templates that I use for Fibonacci's and regular fibs. So on the left, we can see you've got all the regular fibs that I would use, and you can see that we have the 0 to 100 range in there. Now that can give a little bit of clutter when you're applying those throughout a harmonic pattern. So it's best to either apply them, confirm them, then remove them, and go on to the next move. Uh, or when possible, apply these harmonic fibs. So from when you're doing the B to the C, preferably, you would always use these fibs, which are the harmonic templates. And in time, like it's quite interesting because I will show you how to do these, naturally every single day that the market is open. We'll see these patterns. Like I'm that confident that we will see XABCD patterns and ABCD patterns every single day of every single week in the coming future. So it's good to have these patterns down, and once we get all of the basics down and ensure that everyone's comfortable with drawing them themselves and making sure that they are, focused on the right levels and trading them at the correct points, and then we're good to go. But yeah, so the rules for the Gartley pattern, because we're focusing on this one in particular this time. So before you try and trade the pattern, make sure that the following rules are met. So the AB equals CD pattern is one given uh, area that we can really try and get some extra added um, confirmation. And that 78% retracement from the X to the A leg, that's another confirmation indication, essentially, that we can get out of this. So a 127 or 161.8 being the most important level because that's your entry. So we have to be aware of that is the number one fib that's going to be on there. Now, if it lines up with the with the 78.6 from the X to the A leg, that's even better confirmation. If it has an AB equals CD pattern, that's even more confirmation. So if the CD finds support at the 127 or 161 Fibonacci level of the B to the C move is another confirmation. So if it bounces in a bullish direction from the D leg, then that's one of the first signs that it is trying to hold that level and trying to move in favor of that pattern. So generally speaking, when you have a 188 or a 161, or in this case a 127, if it is one of the 127 variants that responded to the 38 on the prior move, then we would be watching for that 127 to hold. And the thing is we wouldn't trade with a stop loss that has a stop loss past the 161 in that case. It would merely be a tight stop on that level in expectations of that level will hold. Now, putting a stop loss 2 levels above that level would not make sense because you're adding risk to the entire pattern. So, yeah, in order to enter a Gartley trade, you should first identify the pattern and then confirm its validity. So, to draw the Gartley pattern on your chart, you should outline the 4 price moves and the swings on the chart to identify and make sure they respond to the respective fib levels, and make sure you mark each price action swing with the relevant letter X, A, B, C, and D. And you can do that, but to begin with, it does help, I would say, to identify your patterns. But the most important thing is to understand exactly where you draw your fibs, because at the end of the day, we're not going to draw the patterns that we see in the back. We're going to draw what fibs correspond, as we can see at the very back of this pattern here. We can see that it's responding to the 127 from its B to C. Now these triangles don't really matter. The fib levels are what matters the most. And yeah, so this is just a basic overview of the bearish Gartley, and I just wanted to go over that real quick. The bearish Gartley pattern is the absolute equivalent of the bullish Gartley pattern, but inverted. In this manner, the bearish Gartley has a bearish XA move, a bullish AB move, and a bearish BC move. The bullish CD move is what you intend on shorting. So this point here. And essentially, that's the area that we intend on entering the trade at the D point on every single XABCD pattern. Now, in many cases, we will understand that the B point is often the price target. But in this case, we can see how it makes a lot of sense for it to actually go to the X to A, to go from the the 161.8 from the A to the D move. So yeah. So this is another example that I've got off of the bearish Gartley example. So essentially, you do want to focus on trying to take profit on each one of the respective points. The entry should be at the D point with a stop loss as tight as possible above the level in which you intended to short at, with which should be a 161.8 or a 127, depending on which variant that you shorted. Now, if the price momentum continues to show signs of strength, you can opt to keep a small portion of the trade open in an attempt to catch a larger move. Now, we do this all the time with the 3 contracts, and then you sell one on the ignition candle, sell one at the price target, and let the last one run. Now, you can do that with this, most definitely. And you would want to use the price action clues such as support and resistance techniques and trend lines and channels and candle patterns to find an appropriate final exit point. But in general, if the price action shows no signs of interrupting the new trend, you can by all means stay in it for as long as you can. And here's an example. So basically, we can see here, like from our X to the A point, our B point is a 61.8 retracement, right down there. And we can see from our B to C point, which is, this moves here is a 88% retracement. So we're just going to go over that here real quick. So we can see from the X to the A, if you apply fibs, got a 61% retracement, which correlates with this number here. I'm just thinking I probably should have done this one first, but that's okay. So we can see that if we apply fibs from the bottom to the top, that gives us our 61.8 B point. Now on our next one, if we apply fibs from the top to the bottom, that gave us our 88.6, which is shown here in this 88.6 indication here. So this basically is just showing us exactly how these numbers are relevant, if you were ever wondering. And then we can see up here from our B to our C point, we had an exact 161.8, right? Now, by all means, it wasn't a 78.6, which it should be here. Now, it's not always the case. It's incredibly difficult to actually get it to line up with that confirmation method when everything else is lining up absolutely perfectly. Now, due to the fact that when everything else is lining up absolutely perfectly, that's all you really need. The levels are what you need to work in harmony with the pattern, and the most important of those levels being that D point. Now, when that D point hits one of these levels, being the 161.8 in this case, we have to make sure that we're aware that that is a very highly probable reversal area. Now, depending on how the size of the pattern, let's say there's like 500 points between the 188 and the 161. Now, what is it to take 5-point stop on the 161 and then try and scalp long to try and get to our 2,000 point profit target of B point? Now, this is just completely an example, of course, but we can see, as a result of it coming from its D point, goes up to its 161.8 and then reverses all the way back down. In this case, the 188. And that's something that you will see that is extraordinarily common. Now, when it did this, it actually made a B point out of the A as well. So as soon as it responded to these respective levels, when you respond and hold a 188 or a 161 of any harmonic pattern, its price target naturally becomes its 100. Because just like we can see on this here, when this held the 161, its price target naturally would be the 100 in many patterns. Now we know with the Gartley has the capability of going up and beyond almost twice the size of the entire pattern all the way to the 161. So that's another major thing. Now, okay, here we go. We can see that that's another destructive move off of the 188. So that's actually all we wanted to go over today. I wanted to keep it a little shorter for you guys. So if you did have any questions, I know there was a lot of content that we went over there. And of course, feel free to join us from open to close with live streams and live analysis all day. But yeah, I will get the recording for this up and available for everyone that's interested. And yeah, if you have any questions,